Welcome back. In this chapter, we will examine the bedrock of North Carolina insurance regulation by analyzing the expansive legal authority granted to the insurance commissioner. The insurance commissioner holds a position of immense responsibility, functioning as the chief regulator of the insurance industry within North Carolina. This authority is explicitly derived from Chapter 58 of the North Carolina General Statutes, which establishes the framework for market oversight. It is important to view the commissioner not merely as an administrator, but as a quasi-judicial authority capable of interpreting and enforcing state statutes. Their mandate is broad, covering everything from the solvency of insurance carriers to the ethical conduct of individual producers. By centralizing this power, the state ensures that insurance remains a stable, predictable, and fair marketplace for all participants. Understanding this role is essential because every action you take as a licensee operates within the boundaries they define and police. One of the most critical aspects of the commissioner's role is the enforcement of insurance laws through investigations and administrative actions. When a company or individual is suspected of violating statutes, the commissioner has the power to initiate an inquiry that can lead to significant consequences. This often begins with the authority to conduct audits and examine the financial records of any insurer authorized to do business in the state. If evidence of wrongdoing is uncovered, the commissioner can issue cease and desist orders to halt harmful practices immediately. These orders function as a summary mechanism to prevent further consumer harm while formal legal proceedings are pending. This preventive capacity is what keeps the market from devolving into chaos, ensuring that bad actors are sidelined before they can jeopardize systemic stability. Beyond mere investigations, the commissioner holds the power to conduct formal administrative hearings, which serve as the due process mechanism for those accused of rule violations. During these hearings, evidence is presented, and the commissioner, or a designated hearing officer, acts as the arbiter of facts and law. These proceedings are not optional and carry the weight of state authority, meaning that subpoenaed entities must comply with requests for testimony and documentation. When a violation is proven, the commissioner has a wide range of administrative remedies at their disposal. These remedies can range from monetary fines to the suspension or outright revocation of professional licenses. This enforcement power serves as the backstop for all regulatory standards, giving teeth to the rules we will discuss throughout this course. The protective mandate of the commissioner also extends deeply into the area of consumer rights and market conduct. The regulatory body is tasked with ensuring that insurers remain solvent and capable of meeting their obligations to policyholders. This is achieved through systematic financial reporting requirements and periodic market conduct examinations that verify if companies are treating policyholders equitably. The commissioner also oversees the licensing process, ensuring that only those who meet the state's rigorous standards for competence and character are permitted to interact with the public. By monitoring for unfair trade practices and discriminatory behavior, the commissioner protects the public from predatory tactics. Essentially, the office acts as the ultimate guardian against the inherent power imbalance between a complex insurance corporation and an individual consumer. As you study this material for your exam, focus on the distinction between the commissioner's administrative powers and the underlying statutory requirements. It is a common mistake to view these as separate entities. In practice, the law is only as strong as the enforcement power behind it. When you encounter questions regarding the scope of the commissioner's reach, remember that it is almost always expansive to ensure the integrity of the state's insurance market. Decisions made by the commissioner are guided by the principle of protecting the interests of the residents of North Carolina above all else. This directive informs every action taken by the Department of Insurance, whether they are auditing a major carrier or investigating a complaint against a local agent. Maintain this perspective as we move forward, as it provides the necessary context for why these specific regulations exist in the first place. I will see you in the next lecture. Welcome back. In this lesson, we will examine the legislative framework governing the North Carolina insurance industry, with a specific focus on statutory enforcement and compliance. To understand the regulatory landscape in North Carolina, one must first recognize the distinction between state statutes enacted by the General Assembly and the administrative codes promulgated by the North Carolina Department of Insurance. Statutes establish the broad objectives and legal boundaries, while the North Carolina Administrative Code provides the granular, operational instructions that insurers and producers must follow daily. When the Department of Insurance interprets these rules, they're not merely offering guidance, but are articulating the standard of conduct expected of every admitted entity. If you're a licensed producer, your authority to operate is predicated entirely on your adherence to these rigid structures. Failing to grasp the legislative intent behind these codes often leads to preventable errors during market conduct examinations. Transparency in these processes is not optional. It is a fundamental pillar of the regulatory contract between the state and the industry participants. By mastering the interpretation of these rules, you align your business practices with the commissioner's expectations, effectively mitigating the risk of inadvertent regulatory overreach or noncompliance. The mechanism of enforcement begins with the commissioner's authority to oversee, investigate, and, where necessary, penalize those who disregard the established standards. When a statute is violated, the commissioner may initiate an administrative hearing to determine the extent of the transgression and the appropriate remedy. These remedies are categorized by their severity and their impact on your ongoing ability to practice within the state. A minor administrative oversight might result in a civil penalty, which acts as a monetary deterrent designed to encourage immediate corrective action. However, more egregious conduct, such as systemic fraud or willful failure to report required information, can lead to the outright revocation or suspension of your license. The law mandates that all admitted insurers and licensed producers maintain certain records and operating protocols, and these are subject to periodic audit by department examiners. Ignoring these requirements is not an exercise in risk management. It is a direct invitation for state intervention that can permanently compromise your professional standing. Understanding the legal repercussions of failure is essential not just for compliance, but for professional survival in this jurisdiction. If an audit reveals that a producer has engaged in prohibited activities, the resulting sanctions often include heavy administrative fines that must be paid within a strictly limited time frame. Furthermore, the commissioner has the power to issue consent orders, which are formal agreements requiring the entity to perform mandatory corrective actions to restore their standing. These actions might necessitate enhanced oversight, mandatory training, or even the appointment of an independent monitor to oversee your business operations. It is important to remember that these enforcement mechanisms are designed to protect the public from harm while ensuring that only reputable individuals continue to hold a license. If you're authorized to sell life insurance in North Carolina, you must maintain a robust internal compliance program that tracks your statutory obligations constantly. By treating these statutory requirements as a bedrock of your business process rather than an external obstacle, you will ensure a long and prosperous career in this industry. See you in the next lecture. Welcome back to our journey through state statutes, where today we turn our focus toward the Unfair Trade Practices Act. We will examine the specific definitions of conduct that the North Carolina Department of Insurance considers fundamentally prohibited to maintain market integrity. The Unfair Trade Practices Act exists as a strict boundary designed to prevent insurers and producers from gaining an advantage through deception or coercion. When we speak about misrepresentation, we are looking at the legal prohibition against making false statements about the terms, benefits, or conditions of an insurance policy. This is not merely about a simple error in communication, but concerns deliberate attempts to mislead a prospective policyholder regarding the nature of the coverage they are purchasing. The law strictly mandates that any illustration or statement must accurately reflect the policy's actual performance and provisions. If an agent asserts that a dividend is guaranteed when it is contingent upon company experience, they have moved into the territory of statutory violation. Such actions undermine the consumer's ability to make an informed financial decision and necessitate intervention by the commissioner. False advertising serves as another critical pillar of these prohibitions, covering any statement that is untrue, deceptive, or misleading regarding the business of insurance. This applies to the financial condition of an insurer, the reputation of a competitor, or the specific details of a policy contract. If a producer publishes information that creates a false impression about an insurer's assets or solvency, they're directly violating these standards. Defamation is also explicitly addressed, specifically prohibiting any oral or written statement that is maliciously critical of or derogatory to the financial condition of any insurer. The intent here is to prevent the spread of false rumors that could incite panic or unfairly damage the competitive standing of a legitimate carrier. These regulations ensure that competition remains focused on product value rather than tactical character assassination. Illegal inducements and the practice of rebating represent some of the most strictly policed areas in professional conduct. Rebating occurs when an agent offers something of value to a prospect that is not explicitly outlined in the policy as an incentive to close a sale. This could take the form of sharing commissions, giving cash, or providing personal gifts that serve as a condition for purchasing the contract. North Carolina law prohibits this because it creates an uneven playing field and introduces an element of bribery into a professional financial arrangement. Similarly, twisting involves using misrepresentation or incomplete comparisons to induce a policyholder to lapse, forfeit, or surrender their current policy for a new one. This behavior is particularly egregious because it often leaves the consumer with less favorable terms while the producer secures a new commission through bad faith advice. Coercion and intimidation are also classified as prohibited trade practices, specifically when an agent or insurer uses physical or mental force to restrict trade. For example, if a lender mandates that a borrower must purchase insurance from a specific agent as a condition for securing a loan, they are engaging in illegal coercion. The statute ensures that the insurance marketplace remains free from predatory tactics that bypass the consumer's right to choose freely. When the commissioner identifies these triggers, they have the authority to initiate administrative investigations, which often lead to heavy fines, license suspension, or permanent revocation of authority. Understanding these mandates is not just about avoiding punishment, but about internalizing the ethical obligations required to serve your clients effectively. By keeping your practices transparent and accurate, you protect both the policyholder's interests and your professional standing within the industry. We have defined the core boundaries that govern professional honesty and market fairness in the state. I will see you in the next lecture. Welcome back. Today, we are starting a critical exploration of producer market conduct standards as defined by North Carolina statutes. We will examine the fiduciary responsibilities, financial record keeping, and the ethical weight of professional representation in this jurisdiction. When you operate as a licensed life insurance producer in North Carolina, the state views your role as one of significant trust, fundamentally necessitating that you hold premiums in a fiduciary capacity. This is not merely a professional suggestion, but a rigid legal mandate, meaning every dollar you collect from a consumer for an insurance premium belongs to the insurer, not you. You must maintain these funds in a manner that ensures they are separate from your personal or general business operational accounts to prevent any possibility of commingling. If you were to mix these premium dollars with your own money, you would be in direct violation of state statutes regardless of whether you eventually remitted those funds to the insurance company. The state requires that you act with complete transparency when handling these assets to ensure the client is adequately protected during the transfer of funds. This accountability extends to any scenario where you may have authority to bind coverage or collect initial payments before the underwriting process is fully completed. Failure to maintain this strict segregation of funds often triggers aggressive oversight from the Department of Insurance, as it indicates a failure to protect the consumer's financial interests. Beyond the management of money, you play a pivotal role as a bridge between the insurer and the applicant, which requires deep clarity regarding who you represent in any given transaction. In the eyes of North Carolina law, you are fundamentally the agent of the insurance company, yet you're held to standards that prioritize the protection of the consumer against harmful practices. You have an affirmative duty to disclose your identity and the identity of the insurer you represent during the initial solicitation process, ensuring the applicant understands that you are acting on behalf of a principal. This transparency is central to the integrity of the insurance market, as the consumer relies on your professional guidance to make long-term financial commitments. If you fail to disclose the nature of your agency relationship or misrepresent the financial stability of the insurer, you face severe disciplinary actions, including the potential revocation of your license. Furthermore, you must exercise diligence in the collection and accuracy of client data, ensuring that all records are maintained according to strict statutory retention schedules. Your statutory obligations regarding privacy and record-keeping are equally robust, reflecting the modern emphasis on safeguarding sensitive personal health and financial information. When you solicit or negotiate life insurance, you likely gather a significant amount of non-public personal information that must remain secure under your control at all times. The Department of Insurance mandates that you maintain clear records of your transactions, including copies of applications, receipts for premiums, and any formal disclosure documents provided to the insured. These records serve as a defensive bulwark, proving that you acted with integrity and complied with all disclosure requirements should a complaint ever arise. You are expected to treat the privacy of these records as a fiduciary duty, acknowledging that any unauthorized disclosure of a client's health information constitutes a breach of the trust inherent in your licensure. Ethical conduct in this context is measured by your ability to document every material step of the interaction, providing an audit trail that highlights your professional adherence to North Carolina's regulatory framework. It is vital to recognize that your professional conduct is constantly subject to the oversight of the commissioner, who holds the authority to investigate your practices based on your adherence to these standards. Diligence is not just about avoiding punishment, but about upholding the professional standard that ensures North Carolina's insurance market remains both functional and consumer-oriented. Think of your license as an ongoing certification of your commitment to these ethical pillars rather than a one-time achievement. Every interaction with a potential policyholder is a test of your fiduciary discipline and your ability to place the interests of the public within the framework of authorized insurance practice. By understanding the distinction between acting as an insurer's agent and the requirement to protect the consumer's interests through honesty, you mitigate personal liability. As you continue your studies, keep this duality in mind, as it forms the bedrock of every regulation we will discuss throughout this course. I will see you in the next lecture. Welcome back. In this session, we will examine the formal process by which the North Carolina Department of Insurance manages consumer grievances and the subsequent regulatory investigations into the conduct of agents and insurers. When a consumer files a complaint with the North Carolina Department of Insurance, the Commissioner initiates an inquiry to determine if there has been a violation of state law or specific policy provisions. As a regulated entity or a licensed insurance producer, you have a statutory obligation to acknowledge these inquiries promptly and provide substantive responses within the timelines mandated by the department. Failing to respond within these periods is not merely a bureaucratic oversight. It is an admission of noncompliance that can trigger formal disciplinary proceedings. The investigation process is designed to be thorough, necessitating that you maintain rigorous documentation of all your client interactions and underwriting decisions. When an investigator requests records, They are looking for objective evidence that your actions align with the statutes. If you cannot produce records that prove compliance, the presumption in a regulatory context often shifts against the producer, making your record-keeping practices the most vital defense you possess. The scope of an investigation often extends beyond a single consumer grievance, as the Commissioner has broad authority to conduct market conduct examinations to ensure systemic compliance. During a market conduct exam, the department will audit your business practices, including your marketing materials, the completeness of your policy files, and the manner in which you handle premium funds. You must demonstrate that your office adheres to the Unfair Trade Practices Act, particularly regarding full disclosure and the honest representation of product features. If an investigation uncovers evidence of fraud, such as misrepresentation of policy benefits or the churn of policies to generate commissions, the department will move toward an administrative enforcement action. This process is governed by strict administrative law protections intended to ensure that all parties receive due process before any sanctions are imposed. You should view these investigations as a functional feedback loop that, while strict, serves to maintain the integrity of the insurance marketplace by identifying and removing bad actors who undermine public trust. Throughout any disciplinary proceeding, it is important to understand that your rights under North Carolina law are clearly defined, providing for notice, an opportunity to be heard, and the right to present evidence in your defense. Should you find yourself the subject of an inquiry, you must provide clear, concise, and documented information that addresses the specific points raised by the investigator. Avoid the temptation to provide vague narratives or extraneous information, as this only complicates the regulatory assessment of your conduct. Instead, focus entirely on the facts. Provide the requested documentation, explain the context of the transaction using the relevant statutes as your justification, and maintain a professional demeanor throughout the communication process. If the investigation reveals an unintentional error, correcting the issue immediately and showing that you have implemented new office procedures to prevent a recurrence often counts significantly in your favor during the final resolution phase. The ultimate goal of the Department of Insurance is to gain assurance that you are operating in accordance with the law, so your cooperation and focus on factual accuracy are your best tools during this regulatory oversight. Until next time, keep your practice in order, and I will see you in the next session. Welcome back. In this lecture, we will define the mandatory reporting obligations that keep a producer in good standing with the North Carolina Department of Insurance. Maintaining compliance involves more than just passing an initial licensing examination. It requires rigorous adherence to statutory reporting rules. As a licensed producer, you act as an extension of the regulatory framework, meaning the Commissioner must have an accurate, real-time view of your professional standing. North Carolina law dictates that you have 30 days to notify the Department of Insurance regarding any administrative action taken against you in another jurisdiction or by another governmental agency. This includes anything from a formal order to a simple disciplinary action, regardless of its severity or the outcome of the proceeding. A common pitfall for many agents is assuming that only North Carolina actions matter. But the statute is explicitly broad to include any domestic or foreign regulatory findings. If you fail to provide this notification within the prescribed window, you are essentially signaling to the Commissioner that your records are not being managed with the appropriate level of professional diligence. This oversight often triggers an immediate inquiry that can lead to administrative fines or, in more severe patterns of neglect, the suspension of your license. Your obligations extend beyond administrative discipline to include personal and professional status changes that alter the fundamental data held by the state. Specifically, any change in your residential or business address must be reported to the Commissioner within 10 business days of the event. While this may seem like a trivial administrative burden, the department relies on these addresses for service of process and official communication regarding your licensure status. Similarly, A legal name change requires prompt notification so that your license documents remain consistent with your current identification. Beyond personal details, you must report the details of any criminal conviction to the commissioner within 30 days of the initial pretrial hearing or the conviction entry. It is important to remember that conviction, in this context, refers to a plea of guilty or nolo contendere or a verdict of guilt, regardless of whether a judgment of conviction was deferred by the court. By keeping your information current, you ensure that you remain reachable for regulatory updates and avoid the logistical friction that arises when official notices are sent to outdated locations. The complexity of operating as a producer often involves shifts in business structure or contractual relationships that trigger specific disclosure requirements. Whenever there is a material change in your business entity structure, such as changing your corporate status or moving to a different legal operating model, you must ensure the commissioner is alerted to these modifications. These reporting requirements prevent a drift between the entities effectively authorized to do business in the state and those that are actually occupying the office space. Furthermore, when you terminate a contract with an insurer, the statutory requirement for notice is grounded in the need for transparency between the carrier and the producer. If you move your business or change your affiliation, be mindful that the Department of Insurance databases must reflect these switches to ensure that your appointments remain valid. Disorganization in this area is a significant flag during a market conduct exam, as it suggests the producer might be operating outside the oversight of the appointing insurers. Treat these mandates as a fundamental part of your professional infrastructure rather than merely as bureaucratic red tape. The enforcement of these statutes is never about the minor inconvenience of filing a form, but rather about the state's interest in maintaining a transparent market for consumers. When you provide notice of a conviction or an administrative action, the department is performing its duty to evaluate if you remain fit for the trust invested in a licensee. Failing to report an action does not just compound the original error. It introduces a separate, independent ground for disciplinary action that is arguably easier for the state to prove. Most producers who find themselves in deep legal trouble with the Department of Insurance did not lose their license because of the original infraction, but rather because they failed to report it in a timely fashion. This creates a situation involving dishonesty or lack of candor, which is always viewed more severely by the commissioner than the original offense. Always prioritize the protocol over the assumption that the department is already aware of your situation through other databases. Being proactive keeps you within the guardrails of the law and protects the continuity of your business. I will see you in the next lecture. Welcome back. Let us dive into the legal gatekeeping mechanisms that define who can operate as an insurance producer within the borders of North Carolina. This chapter covers the exact mandates you must satisfy to obtain and maintain your professional standing before the Department of Insurance. To function as a life insurance producer in North Carolina, you must first satisfy the statutory prerequisites set by the state legislature. You must be at least 18 years of age, which serves as the foundational age a majority required to enter into binding legal agreements on behalf of an insurer. Furthermore, you must provide proof of residency, though North Carolina offers specific pathways for non-residents to obtain a reciprocal license. Before you're eligible to sit for the state examination, you're mandated to complete a program of pre-licensing education. This coursework is designed to ensure that you possess a baseline understanding of the insurance products you intend to sell, as well as the regulatory environment you will occupy. Once the education requirement is fulfilled, you must register for and successfully pass the life insurance examination administered by the state testing entity. The application process is centralized through the National Insurance Producer Registry, commonly referred to as NIPR, which streamlines the filing of your uniform application. When applying, you must disclose your criminal history and any previous administrative actions taken against you by other jurisdictions, as a clean background is a non-negotiable requirement for licensure. If you are applying as a business entity, You must designate a specific responsible producer who will act as the point of accountability for the firm's compliance with state laws. This designated individual must hold an active license in the same lines of authority that the business entity intends to represent. The Department of Insurance requires detailed documentation throughout this process, and failing to provide accurate information upon application can lead to a summary denial or future revocation of your license. Lines of authority categorize the specific products you are legally permitted to solicit, negotiate, or sell, such as life, accident, or health insurance. You cannot legally act in any of these capacities until the commissioner has officially issued your license and the insurer has filed a notice of appointment. This distinction is critical because, while the license confers the legal status to act as a producer, the appointment establishes the formal agency relationship between you and a specific insurance carrier. It is an unlawful trade practice to engage in the solicitation of insurance business prior to receiving both the issued license and the company appointment. Even if you have passed your state examination and paid your fees, you remain legally constrained from transacting business until all administrative hurdles are fully cleared. Maintaining professional compliance within this structure requires a consistent awareness of your specific lines of authority and your relationship with the appointing carriers. If you switch carriers, you must ensure that the new appointment is properly recorded, as you're only authorized to represent companies that have filed the necessary papers with the Department of Insurance. The state tracks these appointments diligently, and any attempt to bypass these requirements exposes you to civil penalties and administrative discipline. By internalizing these requirements now, you prepare yourself for the practical reality of maintaining a compliant business practice. Understanding the barrier to entry is the first step in ensuring that your professional career remains on solid ground from the day you start. See you in the next lecture. Welcome back. In this lesson, we will explore the statutory relationship between a producer and the insurance companies they represent through the appointment and termination process. In North Carolina, a producer cannot act on behalf of an insurer without first obtaining a formal appointment. This appointment functions as a contractual bridge that grants the producer legal authority to solicit, negotiate, and bind coverage for the carrier. When an insurance company decides to appoint a resident or non-resident producer, they are essentially certifying that they have investigated the applicant's character and professional competence. This certification is a significant legal act, as the insurer acknowledges that they are willing to be held vicariously liable for the actions of that producer within the scope of their appointed duties. You must understand that the appointment is not an automatic right upon receiving a license, but rather a separate, voluntary business arrangement between the entity and the producer. Without this documented relationship, any professional interaction attempted by the producer regarding a specific carrier falls outside of the company's formal auspices. This framework ensures that the commissioner can track exactly who is representing which entity at any given time, maintaining clear accountability in the marketplace. The termination of an appointment is a process heavily regulated by the North Carolina Department of Insurance to ensure transparency and prevent misconduct from being hidden between carriers. When an insurance company moves to terminate their appointment of a producer, they must strictly adhere to statutory notification timelines. The insurer is required to notify the Commissioner of Insurance within a specific window after the termination becomes effective. It is critical to grasp that the reason for the termination dictates the nature of the filing the insurer must submit. If the termination occurs for business reasons, such as a producer's failure to meet production quotas or a change in company strategy, the notification is generally administrative in nature. However, if the termination is for cause, implying that the producer has committed a violation of state statutes, engaged in fraud, or demonstrated untrustworthiness, the requirements are significantly more stringent. The insurer must provide detailed information to the commissioner to ensure that the producer's professional status is reviewed in the context of their ability to hold a license. Distinguishing between termination for cause and termination for business reasons is fundamental to your understanding of statutory obligations. A termination for cause often triggers an investigation into the producer's fitness to continue practicing in the state. If an insurer uncovers evidence that warrants a termination for cause, they have an ethical and legal mandate to be forthcoming with the department. This reporting obligation serves as a safeguard for consumers, preventing a producer who has compromised their integrity with one company from simply moving to another without notice. Furthermore, the agency carrier business agreement often contains specific language regarding the return of supplies, files, and premiums collected prior to the effective date of the termination. Failure by the insurer to provide the required notice to the Commissioner of Insurance can result in regulatory penalties, emphasizing that this reporting duty is a core component of compliant business operations. Always remember that the status of the agency-carrier relationship directly influences the legal standing of the producer's licensing status and their ability to conduct business in North Carolina. I will see you in the next lecture. Welcome back. In this chapter, we will explore the procedural requirements for maintaining your professional standing as a licensed insurance producer in North Carolina, ensuring your practice remains compliant and uninterrupted. Obtaining a license is merely the initial hurdle. Keeping that license active requires ongoing adherence to statutory mandates defined by the North Carolina Department of Insurance. The producer license in North Carolina does not run indefinitely, but operates on a specific renewal cycle, which is biennial. You must be proactive in tracking your renewal date, as the Commissioner of Insurance does not serve as a personal reminder service for your administrative obligations. Failure to pay the requisite renewal fees by the established deadline results in the immediate expiration of your authority to transact insurance. This is a critical distinction because engaging in any insurance activity once your license has expired constitutes unauthorized practice. Such unauthorized activity often triggers severe civil penalties, potential criminal charges, and permanent damage to your professional reputation. Always maintain current contact information with the department to ensure you receive renewal notices, though ultimately, the responsibility for timely compliance rests entirely with you as the licensee. When a license expires due to a missed renewal or non-payment, the statutes provide a window for reinstatement, but it is rarely a trivial process. Reinstatement typically requires the payment of the original renewal fee plus a late penalty, and in some instances, you might be required to submit a new application as if you were a first-time licensee. If the expiration period extends beyond a certain time frame, the Commissioner may require you to demonstrate that you are still competent, which could necessitate retesting. It is far more efficient to manage your renewal before the expiration date by utilizing the state's electronic licensing systems. Furthermore, if you allow a license to lapse, you lose your appointments with insurance carriers, meaning you would have to go through the entire appointment process again even after paying your late fees. This administrative burden creates significant downtime where you cannot earn commissions or service your existing book of business. The Commissioner of Insurance holds broad authority to suspend or revoke a producer's license if you fail to meet these maintenance standards or engage in misconduct. Suspension is often used for technical violations, such as failing to respond to a formal inquiry from the department or neglecting simple administrative reporting requirements. Revocation is a terminal action typically reserved for more egregious violations, such as misappropriating client funds or committing fraud, but it can also occur if a producer repeatedly ignores statutory reporting mandates. Before a final order of suspension or revocation is issued, the Commissioner must provide you with an opportunity for a hearing. This is a cornerstone of due process within North Carolina's administrative law framework, allowing you to present evidence or legal arguments in your defense. You have a statutory right to appeal these administrative decisions to the North Carolina court system if you believe the Commissioner has acted outside of their authority. Understanding these mechanics is essential for your long-term success. I will see you in the next lecture. Welcome to this exploration of continuing education requirements in North Carolina, where we will examine the regulatory framework that keeps your professional license active. You will come to appreciate how these mandates are not merely administrative hurdles, but the backbone of your ongoing competency in a complex market. In North Carolina, the Department of Insurance mandates that all resident insurance producers complete 24 hours of continuing education every 2-year licensing cycle. This cycle is fundamentally tied to your birth month and the biennial anniversary of your initial license issuance, meaning every agent operates on an individual schedule. Within those 24 hours, the statute is quite specific about the inclusion of mandatory ethics training, which currently requires 3 credit hours as a dedicated portion of your total requirement. The underlying logic here is that maintaining a license is a dynamic responsibility rather than a static achievement, necessitating continuous engagement with evolving state statutes and industry best practices. If you fail to stay compliant, you risk the suspension of your license, which serves as a potent reminder that the regulatory environment prioritizes consumer protection above convenience. You must internalize these timelines early in your career to prevent the stress of a last-minute scramble to find available courses before your deadline expires. Understanding that you're responsible for your own compliance track record is the first step toward building a sustainable and legally sound career in this industry. When selecting your courses, you must rely exclusively on providers approved by the North Carolina Department of Insurance to ensure the credits actually count toward your biennial requirement. These courses can be delivered through various modalities, such as traditional classroom settings, interactive live webinars, or self-paced online modules, provided they meet the state's rigorous accreditation standards. It is a common misconception that any insurance-related workshop qualifies, but the reality is that the department strictly audits the syllabus and curriculum of every approved offering. From a procedural standpoint, the electronic verification process has largely automated the way these credits are reported, yet it remains your personal duty to confirm that your transcript accurately reflects your completed hours. Never assume that a provider will immediately forward your data to the department, as discrepancies between your records and the state database can lead to unnecessary administrative inquiries. By maintaining your own documentation or digital receipts, you effectively shield yourself from the potential fallouts of a synchronization error between the provider and the state systems. Diligent record-keeping is a professional habit that differentiates a prepared producer from one who simply hopes for the best. The temporal aspect of these regulations is strictly enforced, with your reporting deadline coinciding precisely with the last day of your birth month every 2 years. Missing this deadline triggers an automatic notification system, and the North Carolina statutes dictate specific penalties for producers who fail to satisfy their requirements in time. These penalties often involve the immediate cessation of appointment authority, which prevents an agent from initiating or renewing policies until the deficit is corrected. While the department does offer a window for remediation, the cumulative effect of lapse compliance can lead to the permanent forfeiture of your license, depending on the duration of the noncompliance. It is helpful to view the reporting window not as an endpoint, but as a hard constraint that influences your business planning for the quarter leading up to your expiration. Being proactive ensures that your status remains active, which is a prerequisite for receiving commissions and maintaining your appointments with the carriers you represent. When documentation is incomplete at the moment of an audit, the burden of proof rests entirely on you to demonstrate that you have fulfilled the statutory demands. Effective compliance relies on a sophisticated understanding of how the Department of Insurance tracks your journey as a licensed professional. Every hour you spend in a course is essentially a data point that verifies your ongoing grasp of current market conduct standards and legal obligations. As these regulations change to reflect new consumer protection trends, your continuing education becomes the primary vehicle through which you receive these critical updates. Do not underestimate the importance of mastering the specific nuances of these statutes, as the regulatory landscape is characterized by its rigor and lack of leniency toward negligence. By treating your CE mandates with the same seriousness you bring to your client interactions, you stabilize your career and avoid unnecessary regulatory scrutiny. The system is designed to reward those who stay informed and punish those who disregard the established milestones of biennial reporting. Ultimately, your professional longevity depends on your ability to work within these constraints while providing high-quality service to your policyholders. I look forward to discussing the next topic with you in our upcoming session. Welcome to our discussion on business entity licensing. We are heading into the chapter on entity-level requirements, and I am here to guide you through the complexities of organizational licensing rules. When we speak of an insurance business entity in North Carolina, we are looking at legal structures like corporations, partnerships, and limited liability companies that intend to operate as insurance producers. Unlike an individual producer who applies for a license based solely on their own credentials, a business entity must demonstrate institutional compliance. To obtain a license, the entity must first be properly registered with the Secretary of State, ensuring it has the legal standing to conduct business. The core principle here is that the entity itself acts as a legal person, independent of the individuals who work within it. Consequently, the entity must apply for a specific business entity license rather than relying on the personal licenses of its employees. Failing to secure this separate tier of licensure can result in significant regulatory headaches and potential disciplinary actions for the firm. By treating the entity as a distinct legal subject, the state ensures there is a clear channel for oversight and potential enforcement actions. Central to this regulatory framework is the requirement to designate a licensed responsible producer. This individual, who must also be a licensed, in good standing insurance producer, acts as the primary point of accountability between the firm and the Department of Insurance. By naming a responsible producer, the business entity effectively bridges the gap between organizational behavior and individual legal liability. This person is tasked with ensuring that all employees or affiliates acting on behalf of the firm strictly adhere to North Carolina statutes. If the firm engages in prohibited acts, such as unlicensed solicitation or deceptive sales practices, it is not just the rogue individual who bears the burden. The responsible producer and the entity itself can face administrative charges, fines, or even the revocation of their licenses for systemic failures. This structure enforces a top-down culture of compliance that the state expects from every agency operating within its jurisdiction. Many agencies choose to operate under a name different from their formal legal registration, commonly referred to as an assumed name or a DBA. Under North Carolina law, you are required to disclose any assumed name to the commissioner, and this name must be correctly registered before it appears on any advertisements or insurance contracts. Using an unregistered trade name can cause confusion for consumers and prevents the department from accurately tracking which company is responsible for specific market conduct. Transparency is a recurring theme in state statutes because regulators require a clear audit trail. When a customer initiates a complaint about a policy sale, the commissioner must be able to trace that transaction back to the specific licensed entity, regardless of the marketing name displayed on a business card or website. Therefore, meticulous documentation of these names is not merely a formality, but a core aspect of your operational obligations. The entity also holds a distinct obligation to verify the appointment status of every human producer working under its roof. It is a common misconception that once an individual holds a state license, they are free to sell any product for any company. In reality, that individual must also hold an active appointment from the specific insurer they represent. If an entity allows an unappointed or unlicensed person to solicit, negotiate, or sell insurance, the business itself becomes complicit in the violation. You must maintain internal systems to track these appointments and ensure that no one is performing functions outside their license scope. This responsibility extends to verifying the status of part-time contractors or anyone else interacting with prospective policyholders. Protecting the consumer requires the entity to gatekeep its own operations with rigor, as internal oversight is the primary defense against market conduct violations. Regulation of these organizational structures is intentionally robust because a business entity has the potential to influence a far larger volume of consumer interactions than an individual agent. By requiring separate licensing and distinct accountability through a responsible producer, the state effectively creates a regulatory bottleneck that forces entities to police their own ranks. This is not about making the process difficult for the sake of bureaucracy, but rather about creating a verifiable structure where consequences can be leveled against the firm for failures in supervision. When an agency scales, it often brings in new staff who may not fully grasp the intricacies of state law, and that is exactly when vulnerabilities emerge. The licensing rules serve as a reminder that the agency brand carries the weight of legal compliance on its shoulders at all times. Understanding these rules is essential for anyone who intends to manage or operate a professional insurance agency in North Carolina. I will see you in the next lecture. Welcome back. Today we examined the regulatory landscape for those operating outside standard producer licensing, specifically focusing on exemptions and the mechanics of non-resident licensure in North Carolina. In the North Carolina Insurance Code, the legislature defines specific circumstances where an individual may participate in the insurance value chain without holding a comprehensive producer license. These exemptions exist largely for entities or individuals whose involvement is incidental or specialized rather than transactional. For instance, an officer, director, or employee of an insurer who does not receive a commission for their activities and performs clerical or ministerial acts is generally exempt from licensure. This logic extends to those who administer employee benefit plans or insurance programs for an employer when no commission is involved, as these individuals are not performing the functions of a field agent. However, it is a common point of confusion to assume that this exemption constitutes a loophole, when in reality, it is a narrow carve-out for administrative efficiency. You must perceive these exemptions as strictly bounded by the absence of commission-based compensation, which is the primary indicator of a role requiring state oversight. If a person begins to solicit or negotiate policies, that individual immediately falls back into the statutory requirements for licensure regardless of their internal job title or employer-sponsored program status. The complexity of the insurance industry naturally necessitates cross-border operations, leading us to the framework of non-resident licensing. A non-resident producer is defined as an individual who resides in another state but wishes to transact business in North Carolina while maintaining a primary license in their home state. Under the principle of reciprocity, North Carolina generally grants non-resident licenses to producers who are in good standing in their home jurisdictions without requiring them to pass an additional North Carolina-specific exam. This is a mechanism intended to reduce regulatory friction and promote the efficient movement of insurance products across state lines. Nevertheless, the privilege of reciprocity is contingent upon the applicant's home state providing similar reciprocal treatment to North Carolina residents. If a state imposes retaliatory or discriminatory requirements on North Carolina producers, the commissioner has the authority to adjust or deny licensure to applicants from that particular jurisdiction. This demonstrates that insurance regulation is fundamentally a federalist enterprise where reciprocal respect is maintained through legal parity. While the non-resident license grants legal standing to operate in North Carolina, it does not exempt the producer from the state's regulatory grip. A non-resident producer must demonstrate continuous compliance with North Carolina's market conduct standards, Unfair Trade Practices Acts, and other consumer protection statutes during their tenure in the state. Furthermore, If a non-resident producer's home state license is revoked, suspended, or surrendered, their North Carolina license is typically subject to immediate termination. The obligation to remain in good standing is not merely a static requirement met at the time of application, but a persistent condition of active licensure. Regulatory bodies share an interstate database, meaning that adverse actions in one jurisdiction are promptly flagged across the national network. Consequently, a producer operating in multiple states must manage their professional conduct as a holistic responsibility rather than treating each state's rules as an isolated set of boundaries. Maintaining an active, valid license in your home state is the anchor for all your non-resident authorizations, and losing that anchor causes all other authorizations to come undone. When considering the transition from a home state license to a cross-jurisdictional capacity, it is vital to remember the principle of non-discrimination. The Commissioner of Insurance in North Carolina is empowered to enforce state statutes against any licensed person, regardless of their state of residence. Therefore, if you are a non-resident, you are not operating under the rules of your home state while physically or digitally present in the North Carolina market. Instead, you function under the umbrella of North Carolina mandates, which necessitates a proactive attitude towards staying informed about changes in state-specific requirements. You are expected to notify the Commissioner of any changes in your address or any formal disciplinary actions taken against you in other jurisdictions within 30 days. This reporting duty is a central component of the producer's ethical obligation to the regulatory authority. By understanding these boundaries, you ensure that your business footprint remains compliant while you grow your practice. See you in the next lecture. Welcome back. Today we are diving into the statutory requirements that define the core structure of life insurance contracts in North Carolina. We will examine the mandatory provisions that protect policyholders and maintain market integrity under state law. In the realm of life insurance, a policy is not just a commercial agreement, but a highly regulated instrument designed to prevent consumer exploitation. North Carolina General Statutes 58-58-22 and 58-58-140 mandate that specific provisions appear in individual and group policies to ensure that the terms remain transparent and enforceable. These statutes essentially function as a consumer protection framework, dictating exactly what rights an insured individual and their beneficiaries possess regardless of internal company policy changes. When we discuss contract law, we are not interested in the nuances of marketing language, but in the rigid legal constraints that insurance carriers must satisfy to maintain their license to operate in this state. If an insurer attempts to draft a contract that circumvents these protections, the Commissioner of Insurance has the explicit authority to reject those filings. Consequently, every policy form issued in North Carolina must receive formal approval from the Commissioner to ensure it aligns with these statutory expectations. One of the cornerstones of this regulatory framework is the grace period, which prevents the immediate cancellation of a policy due to a temporary oversight in premium payment. This provision mandates that the insurer allows a specific window, usually 30 days, during which the policy remains in effect even if the premium is late. It is a critical safeguard because it accounts for the reality of human error without stripping the beneficiary of their financial security. Closely related to this is the Incontestability clause, which limits the time frame during which an insurer can challenge the validity of a policy based on misstatements in the original application. After a period typically set at 2 years, the insurer can no longer contest the contract, provided that the premiums continue to be paid, which creates a necessary finality for the insured. Without this, an insurer could theoretically deny a claim decades later by auditing the initial medical history, which would be fundamentally unfair to the beneficiaries relying on the policy's payout. Another essential statutory requirement concerns the misstatement of age or gender, which often directly affects premium calculations and benefit amounts. If an insured individual provides an incorrect age or gender upon application, The statute ensures that the death benefit is not simply forfeited, but is instead adjusted to what the premiums would have purchased at the correct classification. This is a pragmatic, proportional response that keeps the contract alive while acknowledging the actuarial error, rather than opting for a destructive rescission of the policy. We also observe the statutory imposition of a suicide clause, which permits insurers to restrict recovery if death occurs by suicide within a specific period after policy inception. This provision acknowledges the insurer's legitimate need to mitigate moral hazard, yet restricts that denial to a strictly defined timeline established by the legislature. By standardizing these clauses, North Carolina law ensures that the insurance market functions on predictable, transparent rules that govern both the insurer and the policy owner. The delivery of these policies is also a legal event that carries significant weight in contract law. An insurance policy is only considered active and binding once the legal requirements for delivery and premium payment have been satisfied. When a producer delivers a policy, they are fulfilling a fiduciary responsibility to explain these standard provisions so that the insured understands their rights under the law. Failure to adhere to these delivery protocols can leave the contract vulnerable to legal challenges regarding when the coverage actually commenced. It is always helpful to view these statutes as a baseline, where any deviation by the insurance company must be in favor of the policyholder rather than against them. By strictly enforcing these standards, North Carolina maintains a degree of predictability that serves as the backbone of the entire life insurance ecosystem, ensuring that promises made at the time of application are reliably kept at the time of death. I look forward to discussing the specifics of these provisions in the upcoming segments, so I will see you in the next lecture. Welcome back, and let's dive into the statutory framework governing grace periods in North Carolina life insurance contracts. This chapter focuses entirely on the mandatory protections that prevent policy lapse during technical premium delays. In the state of North Carolina, the law is quite rigid regarding the grace period provision, which acts as a safety net for policyholders who inevitably experience an occasional lapse in memory or liquidity. Statutes dictate that every individual life insurance policy delivered or issued for delivery in this state must contain a provision granting at least 1 month or 31 days of grace for the payment of any premium due after the first. This is not a suggestion or a company-specific benefit. It is a fundamental statutory requirement that ensures a policy does not terminate immediately upon the exact due date of a premium. The legal definition here is precise, as it mandates that the policy shall continue in full force during this 31-day interval. Understanding this is essential for a producer because you must be able to communicate effectively that the coverage remains active even if the payment has not technically been processed by the insurer. If we look closely at the language, the emphasis is on the fact that the insurance protection remains uncompromised despite the late payment, provided it is received within that specific window. The statutory rule creates a specific scenario regarding death benefit proceeds should an insured pass away during this 31-day grace window. Naturally, the insurance company remains liable for the death benefit, as the policy is considered in force. However, the law permits the insurer to deduct the overdue premium from the final settlement. If a policyholder dies on day 15 of their grace period, the beneficiary receives the full amount of the policy less the unpaid premium amount for that billing cycle. This ensures the insurer is made whole regarding the premium obligation while protecting the policyholder's beneficiaries from the devastating impact of an accidental lapse. It is a balancing act of equity, where the contract remains enforceable but is adjusted according to the outstanding financial obligations. This is a critical distinction that you must be able to explain with total clarity during a consultation. Failing to account for this adjustment when discussing potential claims can lead to misunderstandings, so master the mechanics of this deduction process as it stands in the statutes. When we transition from individual policies to group life insurance contracts, The statutory requirements shift slightly in their administrative application, but maintain the same underlying core intent. Group life policies are also required to provide a grace period of 31 days for the payment of premiums, though this is usually managed by the master policyholder rather than the individual certificate holder directly. The essential difference lies in the contract structure, as the statutory mandate for group plans focuses on the relationship between the insurer and the entity purchasing the group coverage. Unlike individual life insurance, where the relationship is one-to-one, group life mandates ensure that the entire pool of insured lives is not suddenly disqualified due to a delay in the master premium remittance. You should note that regardless of whether the coverage is individual or group, the North Carolina Department of Insurance considers these mandates non-negotiable. Always remember that these provisions are designed to protect the consumer from technicalities that might otherwise strip them of their insurance benefit during a temporary financial shortfall. As you study these requirements, focus on the legislative intent, which is primarily consumer advocacy and the prevention of automatic forfeiture. By codifying these periods, the state effectively limits the ability of an insurer to act prematurely in canceling coverage for non-payment. This alignment between state statute and contractual reality provides a stable foundation upon which the life insurance market in North Carolina operates. If you encounter a situation where a carrier appears to be violating these timeframes, you must recognize it as a potential compliance failure rather than a contractual variance. The grace period is a statutory privilege afforded to the policyholder, and the rules surrounding the deduction of unpaid premiums from death benefits are firm. Keep these rules at the forefront of your professional knowledge as you evaluate policy provisions. It will serve you well when you are tasked with interpreting the rights of an insured relative to their premium payment obligations. I look forward to our next discussion on contractual protections. Welcome back. Today, we are going to dive into the balance between insurer protection and policyholder rights through the lens of incontestability and reinstatement laws. The incontestability clause serves as a fundamental protection for the policyholder by establishing a definitive time frame after which an insurer cannot challenge the validity of a life insurance contract. Under North Carolina statutes, this period is typically set at 2 years from the date of issue. Once this 2-year window expires, the insurer is legally barred from contesting a policy based on material misrepresentations or omissions made during the application process. This provision is designed to provide peace of mind to the insured, ensuring that their beneficiaries will not face a denial of death benefits due to a minor, possibly unintentional error made years prior. However, it is vital to distinguish between a contest based on misrepresentation and a contest based on fraud, though in many jurisdictions, including North Carolina, even material misrepresentations are generally covered by this time limit. The insurer has ample time during these 2 years to perform underwriting investigations, meaning the law essentially creates a statute of limitations on the insurer's right to rescind the contract. From a systemic perspective, this limitation encourages insurers to be thorough in their initial risk assessment rather than waiting for the death of the insured to scrutinize the application for potential fraud. If an insurer waits until after the policy has been enforced for the statutory period, they are effectively stopped from fighting the claim on grounds of application inaccuracies. It is a necessary friction in the marketplace that prioritizes finality in contractual obligations over the insurer's ability to retroactively correct their own underwriting errors. Shifting our focus to the reinstatement provision, we find a remedy for policyholders who allow their life insurance coverage to lapse due to non-payment of premiums. In North Carolina, the law grants a policyholder the right to request a restoration of a lapsed policy, provided certain conditions are met within a 5-year window following the default. Reinstatement is not an automatic right in every instance, as the insurance company must protect its risk pool from adverse selection. To successfully reinstate a policy, the owner must pay all overdue premiums, often with interest, and satisfy any other indebtedness against the policy that existed at the time of the lapse. Because significant time may have passed since the initial purchase, the insurer is statutorily entitled to demand evidence of insurability to ensure the applicant remains a viable risk. If the applicant's health has deteriorated significantly since the original issuance, the insurer may decline the request for reinstatement to prevent covering a risk that no longer matches the premium structure. This safeguard is essential because, without it, a policyholder could wait until a serious illness occurs before seeking to bring a lapsed policy back into force. By requiring valid proof of good health, the insurer maintains the integrity of the risk pool while still offering the policyholder a fair opportunity to recover their coverage. The reinstatement process essentially creates a bridge between a terminated contract and a functional one, binding both parties to the original policy terms once the conditions of restoration are fulfilled. Understanding the interplay between these two concepts helps one grasp the broader regulatory intent of North Carolina law regarding life insurance. The Incontestability clause protects the beneficiary from an insurer's long-term scrutiny, while the reinstatement rule gives the policyholder a pathway to salvage coverage, provided they remain insurable and catch up on their financial obligations. It is a structured compromise that treats the insurance contract as something more than a mere ephemeral promise. You should pay close attention to the specific timeframes, as these are common areas for examination questions where precision is paramount. The 2-year rule for contestability is an absolute outer limit, whereas the 5-year reinstatement window represents a grace period for recovery. These rules ensure that the business of insurance maintains a level of predictability for the consumer while allowing the insurer sufficient control over the risk they decide to assume. Whenever you analyze a policy provision, always ask yourself which party the law is intended to protect in that specific scenario. Incontestability protects the beneficiary from indefinite uncertainty, and reinstatement protects the policyholder from permanent loss of coverage due to temporary financial hardship. Both are pillars of consumer protection that define how these contracts are treated under state statute. I look forward to discussing how misstatements of age affect these policies in our next conversation. Welcome to this deep dive into the specific North Carolina statutes governing how life insurance companies handle errors regarding an insured's age or gender. We will examine how these contractual adjustments maintain actuarial fairness without voiding the policy. In any insurance contract, the premium is calculated based on anticipated risk, and these risk projections rely heavily on the age and gender of the applicant. When an applicant accidentally or intentionally misstates their date of birth or their gender, the foundation of the premium calculation becomes flawed. North Carolina law provides specific guidance for insurers in these situations to ensure that the policy remains in force while the financial terms are brought into alignment with reality. It is necessary to understand that this is not a mechanism for cancellation, as the statute explicitly aims to preserve the contract while ensuring an equitable outcome for both the insurer and the policy owner. The goal is to correct the math behind the risk transfer, rather than to terminate the legal agreement between the parties. When an insurer discovers that the age or gender of an insured person was stated incorrectly on the application, they are required to recalculate the benefits or the premiums based on the correct information. The rule is strictly centered on what the premium would have purchased at the correct age or gender, given the rate currently in effect by that insurer. For example, if a policyholder represented themselves as younger than they actually were, they would have paid a lower premium than the risk profile truly dictated. The insurance company will not void the policy for this discrepancy, but they will adjust the death benefit downward to reflect the amount of coverage that the premium paid would have purchased for a person of the correct age. This adjustment is an actuarial correction that ensures the risk pool remains solvent and fair to all other policyholders who provided accurate data. Conversely, if the premium paid was actually higher than necessary because the insured claimed to be older than they were, the insurer is obligated to adjust the policy terms in favor of the policyholder. This might look like an increase in the death benefit to match what the premium would have bought for the younger age, or potentially a refund of the excess premiums paid. The statute essentially requires a restatement of the contract to reflect the economic reality that should have existed at the inception of the policy. By codifying these specific recalculation methods, North Carolina prevents insurers from arbitrarily canceling coverage while simultaneously protecting the company from bearing risks that were not properly priced. This creates a predictable legal framework where errors in documentation are solved through mathematical equity rather than through litigation or forfeiture of the policy. It is vital that you remember this distinction as you prepare for your exam, because many candidates mistakenly believe that any misstatement on an application allows the company to declare the policy void. In the context of age and gender, the law explicitly dictates that the insurer must keep the policy in effect and perform an adjustment. This demonstrates the state's commitment to consumer protection and contract stability, provided the essential bargain of the policy can be corrected to reflect accurate underwriting facts. These provisions serve as an administrative correction mechanism that balances the insurer's need for truthful risk data with the policyholder's need for the continued protection of their life insurance coverage. When you encounter questions on this topic, always look for the option that describes an adjustment of benefits or premiums, rather than one that suggests policy termination or rescission of the contract. Applying these rules correctly ensures that the policy functions exactly as it should have if the correct information had been disclosed at the time of application. By standardizing this process, North Carolina law ensures that underwriters can rely on the data provided, while participants in the insurance market have a safeguard against losing coverage due to simple clerical or administrative errors. The statutes provide a clear path forward that focuses entirely on the financial adjustment of the contractual terms. This allows the insurer to maintain their actuarial integrity while the policy owner retains their coverage. It is a pragmatic solution to a common underwriting issue. I look forward to discussing the next topic in our series. Welcome back. In this lesson, we will examine the statutory constraints regarding suicide exclusions and a legal framework governing beneficiary designations in North Carolina. When analyzing life insurance contracts, the Suicide Provision acts as a specific limitation on the insurer's liability for a defined period after the policy is issued. North Carolina state law mandates that an insurer may include a suicide exclusion clause, but this provision cannot legally exceed 2 years from the actual date of policy issue. If an insured individual takes their own life within this 2-year window, the insurer is not obligated to pay the full death benefit. However, the statute is clear that the contract does not simply vanish. The insurer must refund the total premiums paid under the policy to the beneficiary. This serves as a statutory safeguard to prevent the company from retaining premiums while simultaneously denying the mortality risk during the initial contestable period. Once that 2-year period expires, the suicide exclusion is no longer enforceable, and the policy must pay out the full benefit regardless of the cause of death. It is essential to understand that this 2-year calculation runs strictly from the policy date of issuance, not from the date of the application or the initial premium payment. Beneficiary designations are governed by strict rules designed to ensure that the proceeds of a life insurance policy reach the intended party without ambiguity or legal conflict. When an insured individual names a specific person as the beneficiary, that individual possesses a vested interest in the proceeds should the insured pass away while the policy remains in force. If no beneficiary is named, or if all listed beneficiaries predecease the insured, the death benefit typically defaults to the estate of the insured. This process often drags the proceeds in a probate court, subjecting the money to potential estate taxes and the claims of creditors, which is almost always contrary to the insured's original intent. Producers should always emphasize the importance of naming contingent beneficiaries to prevent such administrative complications. Furthermore, if a policyholder is married, There may be equitable interests involved, but for pure statutory compliance, the contract governs the primary distribution of funds as stated in the policy documentation. The Uniform Simultaneous Death Act provides a necessary legal mechanism for cases where both the insured and the primary beneficiary die in the same incident, such as a major accident. If there is no sufficient evidence to prove who died first, the law dictates that the insurance proceeds are distributed as if the insured survived the beneficiary. This prevents the death benefit from passing through the estate of a beneficiary who may have only outlived the insured by a matter of seconds. Instead, the policy proceeds will usually flow to the contingent beneficiaries named in the policy, or if none exist, to the estate of the insured. This statutory rule prevents the assets from becoming entangled in the legal affairs of the primary beneficiary's own estate. It creates a stable, predictable outcome for what would otherwise be a chaotic and legally hazardous succession of wealth. Naming minors as beneficiaries introduces complications because minors lack the legal capacity to enter into binding contracts or directly manage significant financial assets. A minor cannot legally sign a release to receive a large death benefit, which means the court must often appoint a legal guardian to oversee those funds until the minor reaches the age of majority. This court intervention incurs legal fees and imposes strict reporting requirements, which effectively limits the accessibility of those funds for the minor's immediate needs. To avoid this, many policyholders opt to utilize a trust, naming the trust as the beneficiary and appointing a trustee to manage the funds according to the insured's specific instructions. When you advise clients, you must be able to explain that a direct minor designation effectively forces the proceeds into a custodial arrangement. Understanding these nuances helps maintain the policy's integrity and ensures the fulfillment of the insured's long-term planning objectives. See you in the next lecture. Welcome back. In this session, we will examine the specific statutory mandates surrounding the delivery of life insurance policies and the scope of the free look provision. The delivery of a policy is far more than a mere administrative formality. It is a critical legal event that activates the contractual relationship between the insurer and the insured. When an insurer writes a policy, the contract remains in a latent state until it is physically or electronically placed into the hands of the policyholder. Properly documenting this delivery date provides an objective timestamp that triggers various statutory expectations, including the commencement of the contestability period and the free look window. From a defensive perspective, keeping meticulous records of delivery is your primary shield against future claims that the policyholder was unaware of policy terms or limitations. If an agent fails to provide proof of delivery, the burden of evidence shifts, often to the detriment of the insurer, should a legal dispute arise later. You must adopt a process-oriented approach where delivery receipts are verified and stored securely to ensure compliance with the North Carolina Department of Insurance Standards. By treating delivery as a high-stakes compliance event, you effectively manage expectations and insulate your practice from unnecessary litigation risks. The Free Look provision acts as a consumer protection mechanism, granting the policyholder a mandated window to review their purchase in its entirety before becoming fully committed. According to North Carolina state law, this period usually lasts for 10 days following the delivery of the policy, allowing the client to verify that the coverage meets their stated needs and expectations. Should the applicant decide that the policy is not suitable for their financial situation, they possess the statutory right to return the document to the agent or the home office for a complete refund of all premiums paid. This is not a discretionary offer provided by an insurer. It is a rigid statutory mandate that cannot be waived or bypassed through contractual language. The essence of this law is to eliminate buyer's remorse and address potential misrepresentations made during the sales process by giving the client a cooling-off period. If the period expires without a request for cancellation, the policy is considered officially in force under the terms agreed upon during the application phase. Complications often arise when the initial premium was not collected at the time of the application, requiring a different approach to the delivery process. In such instances, the producer is legally obligated to verify that the applicant remains in the same state of health as they were when they originally applied for the coverage. To satisfy this requirement, the insurer typically mandates the signing of a statement of continued good health as a prerequisite to handing over the policy. If the applicant's health has deteriorated since the initial medical examination or underwriting phase, the policy cannot be delivered as originally issued. You must be careful here, as delivering a policy to an individual who has become uninsurable without disclosing their changed health status can lead to severe regulatory consequences and the invalidation of the contract. This protocol ensures that the risk assessed by the company corresponds exactly with the risk they're actually covering at the moment the premium is finally accepted. When an insurance company issues a policy with amendments or riders that differ from the original request, the delivery process must account for these changes explicitly. These are often referred to as policy changes or amendments, and they require the policyholder's informed signature to acknowledge the revisions. You cannot simply hand over the document and assume the client accepts the deviation from their original application without a formal acknowledgement. This requirement exists to ensure the client is fully aware of any adjustments in premium rates, coverage exclusions, or changes in policy benefits that were initiated by the underwriting department. By obtaining the signature on the amendment form, you provide clear evidence that the client was informed of the changes and chose to accept the policy regardless. Failure to handle these adjustments correctly can render the changes unenforceable or create major gaps in coverage that eventually haunt the beneficiary during a claim situation. I will see you in our next discussion. Welcome back. In this lesson, we will examine the bedrock principles that define insurance policies as unique legal instruments within North Carolina. To understand an insurance contract, one must first recognize that it is not merely a commercial agreement, but a legally binding document governed by specific, rigid principles. The most fundamental requirement for any insurance policy is the existence of insurable interest, which dictates that the policy owner must have a legitimate financial stake in the preservation of the insured person's life or property. Without this interest, the policy is essentially seen as a wagering contract, which public policy generally prohibits to prevent individuals from profiting from the misfortune of others. In North Carolina, this interest must exist at the time the policy is issued, ensuring that the contractual relationship is built on a foundation of genuine risk management rather than speculation. When an insurance company drafts a policy, they create what is known as a contract of adhesion, meaning the insurer dictates all terms without input from the applicant. Because the insurer holds the pen, North Carolina courts consistently rule that any ambiguity in the contract language is interpreted in favor of the insured party, acting as a safeguard against overly broad interpretations by the carrier. Insurance contracts are also characterized by their aleatory nature, a concept that often confuses new agents because it deviates from standard economic exchanges. An aleatory contract implies that the values exchanged between the insured and the insurer are not necessarily equal, as the performance depends on an uncertain future event. A policyholder may pay nominal premiums for years and never file a claim, or conversely, pay a single premium and receive a payout far exceeding the total cost of the policy. This unequal exchange is the defining feature of risk transfer, which makes the insurance business model possible from an actuarial standpoint. Furthermore, insurance is unilateral, meaning that only one party, the insurer, makes a legally enforceable promise of performance. Once the applicant has paid the initial consideration, the insurer is bound to pay the claim if the covered loss occurs, while the insured is never under any legal obligation to pay future premiums or maintain the policy in force. For any contract to be considered valid under state law, it must satisfy four essential elements: offer, acceptance, consideration, and legal purpose. The insurance process typically begins when an applicant submits an application along with an initial premium, which acts as the offer to the insurer. The insurer then evaluates this request through underwriting and signifies acceptance by issuing the policy. Consideration is the value exchange between parties, consisting of the applicant's payment of the premium and the insurer's promise to pay for covered losses based on the statements made in the application. Finally, the contract must have a legal purpose, meaning it cannot violate state statutes or public policy, and all parties must be legally competent to enter into the agreement. If any of these four elements are missing, the contract lacks the force of law, and any attempt to enforce its provisions will be rejected by North Carolina courts. When disputes arise regarding policy interpretation, North Carolina courts focus on the objective intent of the parties at the time the contract was formed. Judges will examine the policy as a whole rather than parsing isolated sentences, as the primary objective is to give effect to the parties' intentions within the bounds of state law. If a dispute involves a claim denial, the court will look to whether the applicant fulfilled their duty of disclosure, which is the cornerstone of the principle of utmost good faith. This duty implies that both the applicant and the insurer are expected to be honest about all material facts, as failing to disclose significant health details or misrepresenting financial status can render the entire contract voidable. By understanding these legal frameworks, you move past simply memorizing statutes and begin to appreciate how the insurance contract functions as a stable mechanism for shifting risk in a professional and predictable manner. See you in the next lecture. Welcome back. In this session, we will examine the statutory definitions of misrepresentation and concealment and understand how these acts impact the validity of an insurance contract under North Carolina law. When we approach the application process, we are dealing with the foundation of the insurance contract, specifically the principle of utmost good faith. In a legal sense, misrepresentation occurs when an applicant or an agent provides false information to the insurer, either intentionally or through negligence. If a statement is false and it is material to the risk, the insurer may have the grounds to void the contract. Materiality is the crucial filter here. It asks whether the insurer would have issued the policy or issued it under the same terms had they known the truth. You must understand that even if the misrepresentation was not intended to defraud, it can still lead to the rescission of the policy if it pertains to a material fact. For instance, if an applicant omits a history of a specific medical condition that would have resulted in a higher premium, this is a material misrepresentation. The statute is designed to ensure that the insurer can accurately assess risk, and any deviation from the truth threatens the structural integrity of this assessment. Concealment, while similar to misrepresentation, involves the intentional withholding of information that the applicant knows is relevant. While misrepresentation is often an act of commission, concealment is an act of omission. If an applicant deliberately hides a known material fact during the application process, the insurer possesses the legal right to contest the policy. Unlike an innocent mistake, which might be forgiven through a correction process, concealment carries the mark of intent. From an evidentiary standpoint, the insurer carries the burden of proving that the information withheld was indeed material and that the applicant was aware of its significance. This distinction is vital because the law treats intentional fraud far more severely than a simple clerical error. If fraud is proven, the policy can be voided, and the agent involved may face severe disciplinary actions, including the potential revocation of their license by the Department of Insurance. Agent impersonation and the submission of falsified data represent some of the most serious violations within the industry. When a producer knowingly submits an application that they know to be false, or if they impersonate an applicant to expedite the process, they're engaging in conduct that violates their fiduciary duty. North Carolina statutes demand absolute transparency from producers because they act as the primary interface between the consumer and the insurance company. If a producer facilitates the submission of falsified documents, They expose themselves to legal liability, civil penalties, and permanent disqualification from the profession. You must keep in mind that the accuracy of the application is a shared responsibility, but the legal weight often shifts to the licensed professional. The insurer relies upon the information provided at the point of sale to maintain solvency and to fulfill its eventual obligations to the beneficiaries. The ethical imperative for total accuracy cannot be overstated when navigating the complexities of the insurance application. Every piece of data collected during the initial consultation serves as the bedrock upon which the insurer calculates premiums and reserves. If this data is corrupted by misinformation, the entire actuarial model of the insurer is compromised. This is why you must encourage your clients to be thorough and honest, verifying every claim of health, history, and financial standing. Maintaining this standard not only protects you from regulatory scrutiny, but also ensures that the contract remains enforceable when the inevitable time for a claim arrives. When a claim is contested due to previous misrepresentation, the beneficiaries are the ones who suffer, which underscores the moral weight carried by every signature on an application. Your professional reputation is built on the reliability of the information you steward from the application to the policy issuance. I look forward to our next discussion. Welcome to our deep dive into the formation of insurance contracts, where we will examine the precise mechanisms that turn an application into a binding legal obligation. This chapter is designed to give you a structural understanding of the legal requirements and administrative procedures mandated by North Carolina state law. In this chapter, we will walk through the formal process of insurance contract formation, beginning with the initial application and concluding with the delivery of the policy. You will learn the critical differences between conditional and binding receipts and understand the specific criteria that must be satisfied for a contract to be legally enforceable in North Carolina. We will also cover the essential requirements for document retention and the proper channels of communication between producers, insurers, and applicants. By mastering these regulatory details, you ensure that every policy you handle is fully compliant with state statutes and administrative expectations. This knowledge is not merely academic. It is the bedrock of professional practice and protection for both you and your clients. The formation of an insurance contract begins with an offer, which usually occurs when an applicant submits a completed application along with the initial premium payment. From a legal standpoint, the solicitation made by the producer constitutes an invitation for the applicant to make an offer. If the applicant submits an application without payment, the offer is essentially an invitation for the insurer to inspect the risk and decide whether to issue a policy at standard or rated premiums. When the insurer issues a policy as applied for, they're accepting the applicant's offer, thereby creating a binding agreement. However, if the insurer issues a policy that differs in terms from the application, this acts as a counteroffer that the applicant must subsequently accept. Understanding this flow is vital because the timeline of coverage depends entirely on these specific manifestations of intent and consideration. The initial premium payment is often accompanied by a receipt that dictates when the insurer's liability begins. A conditional receipt provides that coverage is effective as of the date of application or the date of a medical exam, provided the applicant is found to be insurable according to the company's underwriting standards. If the insurer determines that the applicant is high risk or uninsurable, those coverage conditions are never met, and the contract is essentially voided before it ever fully matures. Conversely, a binding receipt, which is less common in life insurance but prevalent in other sectors, grants temporary coverage that remains in force until the insurer formally rejects or accepts the application. Producers must be exceptionally clear with clients about which type of receipt is being issued, as failing to explain these nuances can lead to significant disputes if a loss occurs during the underwriting period. Misleading an applicant regarding the effective date of coverage is a serious regulatory violation that can jeopardize your licensure. Once the insurer has accepted the risk, The physical delivery of the policy acts as the final step in the formalization of the legal agreement. Under North Carolina law, the delivery of the policy is the event that often triggers the commencement of the free look period, allowing the policyholder to review the terms and rescind the contract if they are not satisfied. Constructive delivery occurs when the insurer mails the policy to the producer or directly to the policyholder, which is legally recognized as sufficient evidence that the contract has been finalized. It is the producer's responsibility to ensure that the policy is delivered in a timely manner and that any required updates or amendments are signed and returned. Failure to document this delivery accurately can lead to administrative complications regarding contestability periods and the effective start date of coverage. Maintain meticulous records of when and how the policy was delivered to the client to prove compliance with state reporting standards. Enforceability, of course, requires that the contract satisfies specific legal elements, including competent parties, legal purpose, consideration, and mutual agreement. In the context of insurance, consideration is represented by the premium paid by the applicant and the promise of future benefits provided by the insurer. North Carolina statutes demand that these agreements remain transparent and free from material misrepresentations during the underwriting phase. Any evidence of concealment or fraud can be used by an insurer to void a contract, provided the discovery occurs within the contestable period mandated by state law. As a producer, you function as the primary bridge between the insurer's underwriting guidelines and the applicant's disclosure of personal history. Your role in verifying the veracity of application data is a legal duty that protects the integrity of the insurance pool. Stay focused on these core concepts as you prepare for your exams. See you in the next lecture. Welcome to this exploration of ethics for insurance producers. We are stepping beyond the letter of the law to examine the moral foundations that govern your professional conduct in North Carolina. When we talk about ethics in the insurance industry, we must distinguish between legal compliance and true professional integrity. While statutes define the minimum baseline, your role as a licensed producer inherently carries a fiduciary-like responsibility that goes deeper than avoiding fines. Clients entrust you with their financial futures, often during moments of extreme vulnerability, such as when planning for a family's protection or securing a path into retirement. Acting in a client's best interest requires you to prioritize their needs over immediate commissions or personal gain. This mindset is not just an abstract ideal. It is a pragmatic approach to building a sustainable, long-term practice in this state. If you approach every recommendation by asking whether a choice would withstand public scrutiny, you're already halfway toward maintaining the high standard expected of a North Carolina licensee. One of the most frequent ethical friction points you will encounter involves the replacement of existing life insurance policies. A change in coverage is often marketed with the allure of better terms or lower premiums, but it is rarely straightforward. As a producer, your duty is to conduct a rigorous analysis of the existing policy versus the proposed one to ensure the switch benefits the client rather than just generating a new commission. If a replacement serves only to reset the contestability period or create unnecessary surrender charges, you are likely violating your professional obligation. Failing to disclose the potential downsides of such a move constitutes a lapse in objectivity that can destroy your reputation. Objectivity means presenting both the advantages and the systemic risks of a transition so that the client makes a truly informed decision. Product suitability serves as another pillar of your professional architecture, demanding that you align the product with the client's actual needs and risk tolerance. It is fundamentally dishonest to sell a complex, high-premium permanent life insurance policy to a person who clearly requires a simple, affordable term product for temporary protection. Suitability is not merely a matter of checking boxes on an application, but requires you to actively gather data about the client's financial status and long-term goals. Overlooking these details to push a specific narrative is a failure to exercise due diligence. You must always ensure that the product is a functional solution to a documented need rather than a convenient way to meet a sales quota. When the recommendation aligns with the client's life stage and economic reality, your advice becomes a valuable service rather than just a transaction. Transparency is the final piece of this puzzle, particularly regarding the duty to disclose all material facts during the sales process. Concealment, even if unintentional, creates a moral debt that eventually must be paid, either through lost trust or regulatory intervention. Whether it involves explaining the nuances of mortality charges, the impact of administrative fees, or the limitations of a policy rider, the client has a right to full clarity. You act as the bridge between complex legal contracts and the individual's understanding of their coverage. If you withhold information because you fear it might dampen the prospect's enthusiasm, you're failing your ethical duty to provide full, honest disclosure. Keeping your client fully informed is the most effective way to prevent future disputes and maintain your professional standing before the North Carolina Department of Insurance. Maintaining these elevated ethical standards serves as a shield for your entire career, fostering the kind of trust that leads to long-term client retention. When you treat privacy and personal data as sacred assets rather than mere paperwork, you differentiate yourself as a serious professional. The secure handling of information is not just about avoiding breaches. It is about respecting the sanctity of the private details your clients share with you. This consistency in your practice ensures that your career is built on the rock of reputation rather than the shifting sands of short-term gains. By adhering to these principles, you simplify your life, as honesty eliminates the need to remember complex untruths. Treat every client interaction as an opportunity to reinforce the integrity that the North Carolina insurance community values above all else. I look forward to our next session together. Welcome back. Today we are diving into the critical domain of privacy and security regulations governing your practice as an insurance producer in North Carolina. In the course of your daily business, you encounter a significant amount of non-public personal information, which is any piece of data that allows someone to identify your client. The Gramm-Leach-Bliley Act, commonly referred to as the GLBA, provides the federal framework that necessitates the protection of this data by financial institutions, including insurance agencies. You are legally required to provide a clear and conspicuous privacy notice to a consumer at the point of application and annually thereafter for as long as the policy remains in force. This notice must explain what information you collect, how you share it, and the steps you take to protect it. If you share information with non-affiliated third parties, the law requires that you provide the client with a meaningful opportunity to opt out of such disclosures. Failure to provide these notices or to respect an opt-out request constitutes a violation of state and federal law. You must view these obligations not merely as bureaucratic hurdles, but as fundamental duties that define your professional relationship with the client. Treating personal information with strict confidentiality is the cornerstone of trust in the insurance marketplace. Beyond general financial data, the Health Insurance Portability and Accountability Act, or HIPAA, imposes rigorous standards for the handling of protected health information. When you act in a capacity that involves the processing of medical records for life insurance underwriting, you essentially become a steward of highly sensitive health data. You must ensure that administrative, physical, and technical safeguards are in place to prevent unauthorized access to these files. This means that paper files should be stored in locked cabinets, while electronic records must be protected by encryption, firewalls, and restricted user access protocols. It is a common misconception that small, independent offices are exempt from these mandates. However, the law applies to any entity that handles such data, regardless of organizational size. If you communicate with clients via email, you must ensure that your transit methods are secure and compliant with prevailing standards. A breach of these records often triggers mandatory reporting requirements to both the insured and the regulatory authorities, potentially resulting in steep financial penalties and the suspension of your license. North Carolina statutes mirror these federal requirements to ensure that local consumers remain protected under state law. The Department of Insurance holds the authority to investigate your data management practices during routine market conduct exams or following a reported security incident. You are responsible for ensuring that all personnel working within your office are adequately trained on these privacy protocols. If a data breach occurs, demonstrating that you followed comprehensive internal policies may serve as a critical defense against excessive regulatory scrutiny. You should implement a clean desk policy, utilize shredders for obsolete documents containing sensitive data, and regularly update your security software patches to mitigate vulnerabilities. Remember that the duty to protect consumer information survives the termination of the insurance policy, meaning you must have a secure protocol for the archival and eventual destruction of old files. Compliance is not a static state of being, but a process that requires constant vigilance and adaptation to emerging cyber threats. By maintaining these rigorous standards, you not only avoid the risk of enforcement actions, but also bolster the integrity of the insurance industry as a whole. I look forward to discussing our next topic with you. Welcome to our discussion on the shifting landscape of insurance regulation in North Carolina. In this chapter, we will master the current enforcement priorities of the North Carolina Department of Insurance to ensure your practice remains beyond reproach. Understanding regulatory trends is not merely about passing an examination. It is about recognizing the rhythm of oversight that dictates how you conduct business daily. The North Carolina Department of Insurance, led by the Commissioner, provides clear signals through formal bulletins, which are essential reading for any producer operating in the state. These documents are not suggestions. They represent the current perspective of the regulator on how statutes should be interpreted in the face of modern challenges. When you see a new bulletin regarding emerging technologies, such as the use of artificial intelligence in actuarial pricing or digitized beneficiary assignments, you're seeing the Commissioner's tactical enforcement priority for that fiscal period. A common mistake is to ignore these communications as mere administrative upkeep, when in fact they often signal the specific areas where the department will be focusing its audit resources in the coming months. Staying ahead requires viewing the NCDOI website not as a static repository of forms, but as a dynamic dashboard of the state's enforcement intent. One of the most significant trends we currently observe involves the intersection of new digital distribution models and established consumer protection statutes. As insurers introduce products that utilize complex algorithms to determine insurability or risk categorization, the Commissioner has made it clear that existing transparency requirements remain the absolute standard. You might encounter a scenario where a new life insurance product claims to streamline the underwriting process through automated data harvesting, yet it still fails to provide the applicant with the required disclosures regarding the nature of the data sources. The Department of Insurance views this gap as a failure of the producer to ensure that the electronic process does not bypass legal obligations. You must reconcile the efficiency of the software you use with the permanence of your ethical duties as a licensee. An adaptive practice is one where you independently verify that the digital tools provided by your carriers comply with North Carolina law before you introduce them to a prospective client. Consumer protection remains the pivot point upon which all other regulatory actions turn during an enforcement cycle. We are seeing an increased scrutiny of how information is disseminated during the sales process, particularly when it involves universal or variable life products that rely on projections of interest or market performance. If the Department of Insurance notices a spike in consumer complaints regarding the underperformance or misunderstanding of these products, they will adjust their investigative lens accordingly. This often leads to thematic reviews where the department requests specific documentation across a broad swath of producers to see if a systematic issue exists. Your best defense against being caught in a wide-net investigation is to maintain impeccable records that clearly demonstrate the disclosure process you followed during the initial sale. This includes documenting any verbal clarifications you provided regarding the non-guaranteed elements of a product, as these are frequently the subjects of later disputes. Navigating the NCDOI website effectively is a skill that separates seasoned professionals from those who remain reactive to regulatory changes. You should regularly visit the official bulletins section to monitor for shifts in policy that could necessitate changes to your daily workflows or client communication templates. When a bulletin is issued, take the time to read the full text rather than relying on summaries provided by third-party newsletters, as nuances in legal phrasing often define the scope of the Commissioner's authority. Furthermore, look for reports from the Market Conduct Division, which summarizes common errors found during recent audits of insurance entities. These reports serve as a reliable forecast of what the department considers to be the most critical operational risks. If you align your internal compliance procedures to mitigate the weaknesses identified in those reports, you are effectively inoculating your practice against standard enforcement traps. Consistency in your professional conduct acts as an anchor against the shifting tides of regulatory scrutiny. While enforcement priorities will fluctuate based on the political and economic climate, the core demand for transparency and honesty in insurance transactions is immutable. You should treat every interaction as if it were subject to a formal review, not out of fear, but out of a commitment to the integrity of the profession. This mindset simplifies your compliance work because you are no longer trying to guess which rules are currently in vogue and which should be ignored. Instead, you adopt a high-water mark of ethical behavior that exceeds the minimum standards of the state. By embedding these habits into the foundation of your business, you ensure that you remain resilient regardless of how the Department of Insurance recalibrates its focus in future periods. We will see each other in the next session. Welcome back. We have reached the concluding phase of our journey, where we synthesize the statutory framework and tactical approaches necessary to pass your licensing examination. This final session is dedicated to consolidating your knowledge and refining your mental process for navigating the state exam successfully. To master the North Carolina insurance landscape, you must first recognize that the Commissioner of Insurance holds broad, sweeping authority to enforce the provisions of the North Carolina General Statutes. When you are sitting for the exam, keep in mind that the Commissioner is not merely an administrator, but a regulatory force empowered to issue cease and desist orders, levy administrative fines, and revoke licenses for violations of trade practices. You should equate the Commissioner's role with the ultimate guardianship of consumer protection, meaning any question regarding authority usually tilts in favor of the state's ability to protect the public. Think of the statutes as a rigid set of boundaries where the producer acts as the bridge between regulatory compliance and the policyholder. Whenever you encounter a dilemma during the test, ask yourself what the law mandates to ensure fair practice rather than what might be the most expedient path for the licensee. This focus on standard conduct, such as those defined under the Unfair Trade Practices Act, is exactly what the examiners are looking for in a licensed professional. Transitioning into the operational side of your practice, remember that maintenance of licensure is not a passive activity, but a proactive legal obligation. You have learned that appointment processes, continuing education requirements, and the duty to report notifications are non-negotiable pillars that keep your license active. On the exam, you may be presented with scenarios involving the transition from an inactive status or the specific mandates for non-resident licensing. Do not get distracted by the administrative logistics. Instead, focus on the statutory requirements for timeframes, reporting changes of address, and the fiduciary capacity required when handling premiums. For instance, the grace period is a statutory requirement designed to prevent unintended policy lapse, and the test will often expect you to distinguish between contractual grace periods and the underlying legal mandates. Your ability to distinguish between these technical requirements will prove that you have moved beyond rote memorization and toward a functional understanding of your legal liabilities. When it comes to the structure of the examination itself, you must adopt a methodical strategy for handling complex, multi-layered multiple-choice questions. One effective technique is to read the final sentence of the question stem first, as this often reveals the core legal issue, such as whether a statement constitutes misrepresentation or if a policy provision has been violated. Eliminate the clearly wrong distractors immediately, as these are usually written to sound plausible but contradict the specific statutes we have reviewed. If you find yourself stuck between two seemingly correct answers, lean toward the response that prioritizes consumer disclosure or ethical standards. The state values transparency, so an answer that mandates clear disclosure or adherence to privacy regulations is technically superior to one that ignores these duties. Manage your time by allocating a set number of seconds per question, and do not spend excessive energy on any single item that leaves you rushed during the final 15 minutes. Ethical standards serve as the foundation upon which all these statutes sit, and your conduct must remain above suspicion at all times. The exam will likely challenge your judgment regarding potential conflicts of interest, the handling of sensitive consumer data, or the disclosure of material facts during solicitation. Remember that the law views insurance contracts as instruments of utmost good faith, meaning any concealment of facts creates a legal hazard for the producer. If a question puts you in a position where you must choose between a commission-driven action and a statutory requirement, always prioritize the statute. By viewing these rules through the lens of protecting the integrity of the insurance contract, you transform dry legal text into a coherent professional philosophy. Mastering the law is ultimately about understanding these ethical boundaries, as they define the limits of your authority and the success of your career. I look forward to seeing the results of your hard work.